90% traders lose money, and it's not because they don't know trading strategies, it's all because they ignore risk management. So as a trader, however good your trading strategy may be, but if you do not have sound risk management rules, you cannot make money in the long run consistently as a. So friends, if you are also fed up of losing money, blowing up your trading accounts, then stay tuned with me because I am going to be sharing 3 key risk management rules which are followed by professional traders to make money in the long run consistent. Also do check the description for the links to the free resources. We offer free stock market course, free live workshop wherein I dive deep into details. So don't miss out on that opportunity. Most traders think the secret to making money in the stock market is finding the perfect strategy. That's not the case, my friends. The real secret is protecting your capital so that even if you have consecutive losing trades, your account survives long enough to catch the big win. So now let me show you the 3 golden rules that professional traders never break. So what is rule number 1? We just write it down here. So rule number 1 says never risk more than 2%. I'm sure many of you all are aware of this, but do not follow it. So what does it say? So if your trading capital is, let's say, 1 lakh rupees, you should not risk more than 2,000 rupees per trade. And friends, I would say this is the maximum that you should risk. As a new trader, you can even risk much lower, start with 0.5% risk or a 1% risk. That's good enough. But yes, as you are proficient with your trading, good with trading strategies, then I would say you can gradually increase your risk to 2% but never exceed that. And why is it so important? So let's look at some scenarios over here. So scenario number 1, let's say we have an initial capital of 1 lakh. We start our trading with a 1 lakh capital and risk per trade we do not follow that rule. Now we disregard it and keep it at 10% risk per trade. So if you're risking 10% per trade, the capital is 1 lakh. So what will be your rupee risk per trade? So that will be capital multiplied by 10%. So now you're risking 10,000 rupees per trade. So even a single trade goes against you, you stand to lose 10,000 rupees. So let's assume we have a consecutive losing streak. 5 trades that we have taken, we encounter losses in all 5. So let's say the losing streak is of 5 trades. So if you lost consecutively 5 trades, 10,000 risk per trade, so your total loss will be loss per trade multiplied by number of losing trades. So you are now at a loss of 50,000. So your trading capital now would have reduced. So from 1 lakh, you lose 50,000. So what's your capital now? Capital will be 1 lakh minus the loss. So now you're left with only 50,000. Imagine this streak goes on for 8-10 trades. Your entire account would be blown out 8 or 10 trades. So friends, the key is to remain in the trading business for a longer term. If you're going to blow up your account in that span of 8-10 trades, then you cannot be consistently profitable as a trader. So over here, assuming we have lost that 50,000 rupees, now to come back to our capital of 1 lakh. So 1 lakh rupee capital has come down to 50,000. We lost 50% of our trading capital. But to come back to break even, we need to now grow this capital by 100%. So on 50,000, you need to make another 50,000 just to come back to break, which is a very, very difficult. So instead, we should follow the sound risk management principles. So what is it? Risk per trade at 2%. So let's simulate with that. And the same capital you start with 1 lakh. And now what will be your number of losing trades? Let's say again consecutive loss of 5 trades. So what is our total loss now? So risk of 2%. Let's calculate that. 1 lakh into 2%. So 2,000 is your loss per trade. 5 losing trades. So you stand to now lose 2,000 into 5. That's about 10,000 rupees loss. So your capital from 1 lakh now would have reduced to 90,000. Still you have enough money for the next trade. So it is very, very important that you stick to the rule of not risking more than 2% per trade. There will be losing streaks as a trader. It is important that you see through these losing streaks and bounce back as it. So the goal isn't to be right on every trade. That is not our goal. Our goal is to stay in this business for the long run. So that was our rule number 1, not risking more than 2% per trade. So now let's look at what is rule number 2. We delete this. Rule number 2 talks about stop loss. So what does it say? Always use a stop loss and stick. This is what most traders would have learned, heard, but are not following. Whenever I discuss with traders, friends, the feedback that I get, we should not use a stop loss. The moment I put a stop loss on the system, it takes my stop loss and then goes in my favor. Friends, that's probably because you are not putting the stop loss in the right area. So as important as a stop loss, it is more important where to exactly place them. So many traders, what they do, they put stop loss basis of risk tolerance. Assuming that you have entered a trade at 100 rupees, some traders say I can take a 2% risk, I'll put a stop loss at 98. Some traders say I can take a 1% risk, I'll put the stop loss at 99. So all that stop loss is not a technical stop. It is as per your risk tolerance. So market does not know your risk tolerance. So why should it adhere to it? So key is to put stop loss on technical level. So friends, I am a supply and demand trader. I follow supply demand trading methodology. So I will place my stop loss beyond my zones. Assuming this was a trade which I had entered, gone long when the price came into this demand zone around, let's put a line here, the price was about 817, 818 rupees. My stop loss would go below my demand. I will never put a stop loss within the demand zone. If I put my stop loss somewhere inside the zone, it is very likely that it will get stopped out. So putting the stop loss in the right area is very important. So as supply demand traders, we put our stop losses beyond our zone. So those are technical levels. So if those levels are broken, then no longer the trade setup is valid and we do not want to remain in the trade and we would like to exit the trade with a small loss. So again, I repeat, it is very important that you decide a stop loss basis on technical terms. It should not be just arbitrary stop losses. It should be on technical levels, whatever technical strategy that you are following, and do not place it in very obvious areas. Most institutions, most traders would know where they will have a lot of liquidity, where a lot of stop losses would be placed. So as supply demand traders, we place it beyond our zones. So if you are trading without a stop loss, friends, you are not trading but you are gambling, and gamblers don't last for too long. Now coming to rule number 3. What does it say? Delete this. So rule 3 talks about reward to risk. So rule number 3 is aim for minimum 2:1 reward to risk ratio. Or so what is risk and reward? So friends, assuming we plan a trade and our same simulation, 1 lakh capital, 2000 rupee risk per trade. So that is our risk element. We are risking 2000 rupees on that particular trade. But we should aim to make at least 4,000 when the trade goes in our favor. That is 2 times the risk that we had taken. If risk was 2,000, a 2:1 reward to risk ratio would a reward of 4,000. So we should aim for minimum 2:1. So this is the most important concept that separates amateur traders from professionals, friends. Lots of amateur traders ignore this. They focus on being right more number of times. Friends, it is all about being profitable when you are right. Make big profits when you are right. Lose small when you are wrong. And just because I want 2:1 doesn't mean that the market will give me 2:1. So whenever we plan trades, we look at potential reward to risk ratio on the trade. Assuming I had planned to go long at this demand zone with my entry at about 817.75, stop loss around 804. So my risk would be 817.75 minus 804. So roughly about 13 rupees 45 paise would have been my risk on one share. If I would have taken only one share, I would have lost 13 rupees 45. But since I want to put 2000 on this trade, 2000 divided by 1345 would give me my position size. How many shares I would want to buy. So if I am risking 13 rupees, 2 times target would be at least 26 rupees. So what I will check in the chart, where is my opposing supply or opposing resistance? So my technical target will always be the opposing. So I will do my calculation from my entry point till the opposing supply, what is the potential that this chart has to offer me. So I'll just use the long position tool here. I'll place it at my entry point, adjust it to my stop loss and drag it all the way till the opposing supply, slightly before opposing. So can you see it says I'm risking 13 rupees 45 paise and there is a potential to make 35 rupees profit, 35.40. So 35 rupees 40 is the potential target that this trade is offering against a risk of 13 rupees 45 paise. So it gives me a risk reward ratio. 35.40 divided by 13.45, it says I'm having a potential reward to risk ratio of 2.6:1. So that's how I will check for my risk reward ratios. If the reward to risk ratio is not favorable, assuming this was giving me anything less than 2:1, I would forego that trade. I would not go ahead and take. So whenever you are looking for a trade setup, please ensure that you are having minimum 2:1 reward to risk ratio based on whatever strategy you are trading. So as supply demand traders, we will target the opposing zone as our technical target. If there is any zone before that level, that means it is hampering my reward to risk ratio. So I should not take that. Yeah. So minimum 2:1, higher reward to risk ratio it is. So minimum target for 2:1. And why 2:1? Assuming friends you have a strike rate of 50%. Out of 10 trades you take, 5 are losing trades, 5 are winning trades. And if you are trading with 1:1 reward to risk ratio, you will just end up break even. But in the 2:1 risk reward ratio, 5 trades losing, you're losing 1 hour, that means you have a negative 5 hour loss. 5 trades which are profitable at 2 hour, you're making a 10 hour profit. So 10 hour minus 5 hour would at least give you 5 hour reward. So that's how as a trader you need to think about having healthy reward to risk ratios in your trade set. So if you do not respect the reward to risk ratios, friends, you will never grow your account. That is why I teach this in depth in my free workshop. So let's talk about the common mistakes that kill trading accounts. So we already discussed not following stop losses, not having healthy reward to risk ratios, and risking big amounts on a trade, using leverage, taking very big positions, losing big amounts of money over there, and getting into that revenge mode, over trading. All these are recipes for disaster. So stay away from that. So key is, friends, stay disciplined, follow your risk management principles. That is what is going to separate you from the other traders. So as a professional trader, stick to your risk management rules. So if you found this valuable, friends, imagine what you will learn in the free stock market course, the live workshops that I conduct, where I dive deeper into all this and also share my trading setups. So what do you get in the free trading? In the free training, friends, you will learn risk management strategies, position sizing, how to identify high probability trading opportunities basis of my trading strategy, and also we would have a live Q&A session where I answer all your trading queries. So don't miss out on the opportunity, friends. Click the link in the description and register for the free upcoming workshop and start trading the right way.